Hello everyone. Welcome to this special edition where we discuss about the India market outlook for second half 2025. And today I'm joined by a very special guest, Mr. Manpreet Gill, Chief Investment Officer, Africa, Middle East and Europe. Hello Manpreet, welcome to India.
Thanks for having me. It's always a pleasure to be back.
So let me kickstart with the first question on investors' minds. We've had a very volatile first half, but with a very favorable risk environment, despite the numerous risks. So how do you see that? What are the lessons that investors can take away?
Well, actually, the biggest lesson that I think we learned in the first half, and particularly in quarter two, is the importance of not only getting invested, but staying invested and analyzing information with a cool mind. So, April was perhaps one of the hardest months to keep you cool through that journey. But it's interesting that when you look at the global equity benchmark, perhaps the broadest measure of stock markets, in the early parts of April, we actually saw that drawdown about 10%, which was a significant drawdown. But when I look at the performance of the full quarter, from March 31st to June 30th, that same global equity benchmark was up about 11%. So with the benefit of hindsight, of course, the best thing to do would have been not only to get invested, but actually stay invested. And I think it's been a great lesson in not only navigating volatility, investing with a cool mind, but the importance of sometimes just, staying invested through the ebbs and flows of markets, despite the many risks out there.
So sticking to staying invested, if we go into second half of 2025, what is our macro theme and where should we position?
So a big picture macro theme is that we think the global economy, and specifically led by the US, will be able to achieve a soft landing. And what I mean by that is we know growth is slowing in the US. And inflation, of course, is the challenge we're following. But we do think economic growth will stabilize at a positive level. And that's an important detail if you're an equity market investor, because we think that will be sufficient to deliver the earnings growth that are required for markets to do well. We are keeping an eye on inflation. That's obviously the risk. But in a base case scenario, we don't expect that to be a major challenge. And we think that part of that growth outcome will occur because policymakers will be able to support growth. So in the US, we do expect the Fed to start cutting rates, possibly as soon as September. But even outside the US, we know the ECB has been cutting rates, and many emerging market central banks have been cutting rates. Indeed, in India, we've got one here. But it's not just the central bank side. We've got fiscal stimulus, coming from Germany, of a scale we haven't seen in a long period of time. And in China and India, we've seen a steady trickle of not only fiscal stimulus, but also the monetary stimulus. So overall, growth that is witnessing some pressure, but we think with that policy support, able to achieve a positive and relatively constructive level.
And given this macro backdrop of some support coming from policy to growth, what are the asset class implications? I'm guessing equities would still be an overweight?
Absolutely. So I think whether we look onshore in India or globally, I think equities remains an overweight. We still think there's room for it to outperform bonds and cash. But globally, we think the regional sort of conversation will become much more important. One of the big themes actually of our second half outlook is that we expect a weak US dollar. And that's interesting because historically, as long as an outright recession was avoided, periods of weak dollars were actually good for equities, but more importantly, they were good for the outperformance of non-US equity markets, particularly emerging markets like India. And so that's something we've sort of baked into our views, which is to say, look, yes, we're overweight equities relative to bonds and cash, but we've shifted our regional overweight to Asia ex-Japan, away from the US. And similarly, on the bond market side, we moved our overweight to emerging market local currency bonds, partly because of the dollar view and partly because we think emerging market central banks have more room to cut rates.
So from asset class implication on global equities and global bonds, what's the one for India? How do you see India in this entire picture?
So I think India actually ends up in a really positive place, because I think when you have a weak dollar and economic growth that keeps its nose above water, that's a combination where which is good for the outperformance of emerging markets. We are indeed overweight Asia ex-Japan equities, so that's a bullish view on markets across this region, including Indian equities. The only sort of area where we've left India at more of a core holding view is within the region, because while we expect all Asian equity markets to do well, we do think when you have in bull markets, we've seen the cyclical markets in North Asia, China and Korea, perhaps perform a little bit better. But outside of that, we're fairly constructive on Indian markets in that dollar week period and well-supported growth environment.
So Manpreet, in our key theme, stay bullish and selective, what is your top 3 takeaways?
Well, I think the top 3 takeaways within our theme for the second half of 2025, we have 3 themes. One, of course, is to prepare for a weak US dollar. And as we discussed, that's not really just about currency markets, but about the implications that has for other asset classes. Historically, periods of weak dollar not only been good for equity markets, but also for the outperformance of non-US equity markets. The second theme is to be overweight equities. And some of that, of course, draws from a weak dollar view. But we do think that regionally, it's more attractive to overweight Asia ex-Japan equities, which includes India, of course. And on the bond market side, to overweight emerging market local currency bonds, which should also benefit not only from a weaker dollar, but also greater room for central banks here to cut rates. And the third one is in terms of risks, to keep an eye on inflation, particularly in the US, because in the long list of things that could potentially go wrong, we do think any upside surprises in inflation, of course, would potentially limit room for the Fed to cut rates and support growth that we assume in our base case scenario. And I think, diversifiers like gold, those are the examples of asset classes that can help protect against either risk itself or even market worries or jitters about those risks playing out temporarily.
Thank you, Manpreet, for giving those top 3 takeaways. And to our listeners, thank you for joining us today. And if you want a copy of our report, please reach out to your relationship manager.